I'm Evelyn Risley with DealBook for the New York Times. Here with my colleague today, I'm Nelson Schwartz. He's a reporter at the New York Times. Thanks for joining us, Nelson.
Good to be here.
So we just published a series of articles on the extreme interest in technology startups these days, especially the popular ones like Facebook and LinkedIn. And you did a deep dive on the IPO of LinkedIn and who was able to cash out. What's your impression of all this new money in Silicon Valley?
Well, I think everybody's talking about, is there a bubble, is there not a bubble? Either way, there's a tremendous amount of interest from both institutional investors and ordinary retail investors in this sector, particularly social networking stocks. I think last time, 10 years ago, it was just technology in general. Now it's really, really concentrated in those names with, it looks like maybe Groupon may be the next to go public, but everybody's eyeing and offering. And I think a lot of ordinary investors and just people on the web and message boards are all talking about what's the best one, kind of thing.
Yeah. What did you find most remarkable in who was able to make some money out of LinkedIn's IPO? I mean, obviously Reid Hoffman, the founder of LinkedIn, made a lot, but there was a lot of other characters who also did as well.
What I found really interesting is just how many early employees, earlier investors, and even people in the secondary markets, which you wrote about in a separate story, how many of them really got in at prices well below where it went public and even further below where it's trading now. So obviously, for the people, the later you came in, the harder it was to make money, basically.
Yeah. And there's a lot of IPOs coming out later this year, probably Groupon, Zynga, those are the most talked about. What do you expect in terms of pricing for these IPOs? That's been a little bit of a tricky area for bankers, right? Some of the bankers were criticized heavily for LinkedIn's IPO, even though if you look at the current stock price, it seems to be not that far off from where they had priced it.
Right. I think basically, they did a better job in retrospect. At the time, everybody was really, really critical. The stock opened at 83, went all the way up to 122, and now it's down at about 65 as of Friday. And I think, like I said, in retrospect, it looks like a smarter call. But I think the fact that it went up so much is going to encourage the underwriters to be more aggressive in terms of pricing. When Facebook and Groupon and Zynga come, they're going to be less likely to build in such a big discount and sort of go for that because of all the criticism that was leveled.
Yeah, and we saw in the Pandora IPO they were definitely more aggressive, and that seemed to be roughly on the right mark. Groupon, Facebook, Zynga, I mean, those are going to be some huge IPOs that should do well pretty much almost regardless how the rest of the market is faring.
Yeah, one thing I found out that was really interesting is I think it's going to be a lot of profit for Wall Street in these. LinkedIn apparently pressed Wall Street and the bankers to kind of cut that 7% traditional underwriting fee, and none of the banks would budge. Even though they all wanted the business, nobody would budge. LinkedIn actually got them to agree to contribute a portion of the fees for the IPO to a foundation to sort of promote economic opportunity, which is interesting, which they're going to do. But Wall Street wouldn't budge, and I think they didn't want to budge in part because you got all these other deals coming down, and it would have been a bad precedent for the banks to say, okay, we're giving LinkedIn a break.
Yeah, well, lots more money to be made, it seems.
Yeah, exactly.
Thanks so much, Nelson. My guest today has been Nelson Schwartz. He's a reporter at the New York Times, and I'm Evelyn Risley with DealBook for the New York Times.